Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review, and it is Monday. It's the 21st of August. My name is Russell Shaw. I'm a Senior Market Specialist at FXCM, and I just want to draw your attention to my email address, rshaw@fxcm.com, and if you'd like to correspond, send some emails to that address, and I'll reply as soon as I'm able to. I know there's one or two that are in the inbox at the moment. I'll get around to those today. And I'm going to go ahead and bring up our disclaimers. We'll start off with a high-risk investment warning. Good morning, Kim. Nice to have you on the webinar. Thank you for joining. Good morning, Raj. Thank you for signing in. Pleasure to have you on the webinar. Thank you, everyone, for signing in this morning. All right, here is our market commentaries disclaimer. Keep that on screen for a few moments as well. And finally, here is our references, MarketScope 2.0 and TradingView. I'll just bring up MarketScope to start off with, and of course, we'll be looking at the US dollar at the very beginning. And it's we're at an interesting resistance level on the US dollar. We have spoken about it, and the question is, of course, is this resistance level going to hold? Do we have a key reaction level here? My feeling is that we are missing some information, and we did speak about this last week. I think we need one more candle just to show if there is a key reaction off. And if we get something that looks like this, it would bring up what we call a reference candle reversal, right? In other words, every time the dollar has hit this resistance, it's shown some reaction. So hits, reacts, hits, reacts, hits, reacts. Well, now we've hit, we're waiting for the reaction. And of course, keep an eye on that RSI. That RSI is above 50. The longer it stays above 50, the greater the chance that we actually break above this resistance level. We are really, I think, at a very interesting point on the US dollar chart. And the reason that we start off with the US dollar chart is because if you think about it in terms of a chain, the dollar is the first link and it's a cause and effect. So what happens with the greenback ripples across the chain. It's a chain of causality. Now, we have the big story. And what's the big story? It's yields. Okay, the big story is all about yields. So if we go through now to TradingView, what I have here is the real yield, and it is it's showing incredible resilience, incredible strength in terms of yields moving up. Bonds themselves are getting sold off, but the yields are getting higher and higher, and they're becoming quite attractive. This is the real yield. This is what the yield is after taking into account for inflation. So you'll go into a bond, purchase the bond, and what it's doing is that the yields, okay, will cover inflation and then some, and that's quite attractive. That's quite attractive, and you can see that we're getting the this push up in the real yield. And if I take out the inflation adjustment, okay, if I take out the inflation adjustment, so we just now look, instead of taking a look at the real yield, we just take a look at the nominal. So we just take a look at the US 10-year, okay. We're at close to 4.3%. How high can we go? How high can we go? And if I go back in time, let's make this the monthly. Well, I think the next level of interest is at 5% level. So we kind of right, 5. Here it's This is May 2007. It's at 5.2%. Now, this is the big story, yields moving up. What are yields actually doing? Well, I think what they are doing is they are supporting the dollar. So that means if we are currency traders and the yield supporting the dollar is potentially putting pressure on the majors because the dollar is being pulled up here. So potentially some sort of headwind that's acting against the majors. If you are a trader that likes looking at indexes, okay, well, what is higher yields doing? Higher yields are putting pressure on the risk indexes. Take a look. Let's go back to the weekly. Let's go back to the weekly, and let's put in some. Let's put in some charts underneath that, and let's go ahead. Well, let's put it in oil. Let's put in energy underneath that first. Let's see what's happening with energy. Okay, so I'll just put in UK oil. I'll put that underneath. And from about this level, let's maybe even go to the daily. Okay, you can see that yields being pulled up. Well, yields being pulled up as oil moves up. That makes sense because what we've spoke about previously is oil facilitates some sort of inflation. And if inflation is now being bolstered, yields are going to be bolstered. So it makes sense that we're seeing some bullish energy on the oil side, the energy side of things. Okay, but what else? What else is the yield doing? Okay, let's, instead of taking a look at energy, what about if we take a look at technology? Let's take a look at NASDAQ. Okay, so go through to NASDAQ 100. Okay, and you can see that as the yield's being pulled up, the NASDAQ has been pushed down. NASDAQ's been pushed down. I want to show you why that is. Okay, so we're going to just do a little bit of mathematics here. I don't want to get too heavy into it. I just want to show you the formula. We've done it before. Let's just do it again for people that haven't seen it. And you've got a formula that effectively looks like the present value. The present value of stocks is based on the future value divided by 1 plus, I'm just going to call it interest, it's actually the rate of return, and that's to the power of how often we earn cash flows. Okay, so what's happening in, I'm going to just rewrite it like this. So this is effectively future value. Okay, now we've got a line here. The future value is what we call the numerator, and then the 1 plus I to the t, that's the, sorry, I'm going to make that a small t, that's the denominator, okay, and that equals, and here we've got present value numerator, present value is the numerator, and we can just put that over 1, okay, where 1 is the, all right. So again, I don't want to get too, unless you ask me to sort of do examples, all I want to show you is that when we see the interest rate, which is on the denominator, moving up, okay, so the interest rate's moving up. How do we know the interest rates? I'm showing you the real yields moving up. The real yields moving up, that's on the denominator side. Well, that would be putting a pressure on the numerator side. These are inversely correlated, okay, inversely related to each other, I beg your pardon. So as the interest rate gets pushed up, present values tend to get pulled up. That's a mathematical relationship. Okay, it's a mathematical relationship. So if we go back to, we can see yields moving up. That's on the denominator side, and it is acting as a headwind against the Nasdaq because of the inverse relationship, and that's called the time value of money. So the time value of money is effectively giving us this type of relationship. As the real yield moves up, the Nasdaq moves down. So let's just put everything together. So let's put all the complications aside for now, put the mathematics. Real rates moving up, energy moving up, dollar being supported, risk indexes being pushed to the downside. That's the environment we find ourselves in as traders. Okay, what's the sort of big deal at the moment? The big deal, interest rates, and we want to see how the dollar behaves around those interest rates. The fact of the matter is, we've got to ask ourselves, why are long-term interest rates being elevated? My feeling is they're being elevated because the US economy is strong, it's resilient, it's open to demand side forces, and I think that the Fed needs to remain higher for longer. And the market's starting to recognize that the Fed needs to stay higher for longer, and that now is starting to act as that headwind against the stock market, and it's starting to support the greenback, and that's where we find ourselves. So given the fact that we've moved up to this resistance area, but the fact that the RSI is above 50, let's go down to the hourly chart here, and it does look as if there is some positivity with the greenback. It's in what we call zone 1. Zone 1 is between the upper blue, upper red on our daily. Okay, as long as it stays between the upper blue and the upper red, it's in the bullish channel, and you've got the RSI above 50. Go down to the hourly. Let's see what's happening on the hourly. And here we get some interesting movements here. Let's go all the way to the right. It looks as if we're getting a golden cross, okay, on the trend following indicators, and it looks as if the stochastic has crossed to the upside. So potentially some sort of greenback strength coming in. Now, I don't know if the greenback is going to go, if the stochastic of the greenback is going to go into what we call the upper quintile. But if it does go into the upper quintile, then we would most likely have a swing taking place on the dollar. Now, if the dollar is starting to swing to the upside, then I think that's going to act on a whole lot of instruments. Okay, the big sort of divider there is if it makes it into the upper quintile, capital I, capital F. Okay, so we want to see if we can get this up into there. Then we start getting a swing. Let's take a look and see what's happening on the euro side of things. And to me, I'm finding the charts quite challenging because we are at on the dollar we are at resistance, and on the euro we are at support. We don't know if these key levels are going to hold yet. Okay, that's still the big question mark. The big story here, remember, is the interest rates, the yield, and that I think is the key driver of the market. The key driver is not the resistance, the key driver is not the support, the key driver is the yield. And you can see that the RSI has dropped below 50. Well, if that is so, take a look what's happening on the daily chart. We've dropped into zone 3. Okay, zone 3 is between the lower blue and the lower red. And let's just go down to the hourly chart and see what's happening here. I'll just clean this up. And what would be interesting is if we get a dead cross in the trend following indicators. We already got a bearish cross on the stochastic, and if the stochastic pushes down to the lower quintile, we want to be cross-referencing that with the dollar, just to see if there is sort of an equal but opposite type of signal there. So the greenback should be pushing into the upper quintile, while the euro should be pushing into the lower quintile. But we've got to wait to see if we get that dead cross. What's the driver here? US interest rates. US interest rates seem to be the key driver. We want to see if those continue higher today, okay, then that potentially acts as a headwind on the euro US dollar. We are already seeing the influences of the higher interest rates on gold. Let's just do a quick analysis of what's happening on the gold chart here. And this is truly interesting. We go through to the weekly chart. Let's bring up gold. All right, and take a look what's happening here. Lower peak, okay, lower peak. Let's take that out. Lower peak. This is a lower trough. We can take the question mark out. Let's write it out. Lower trough. Okay, so we've got a lower peak followed by a lower trough. Well, a lower peak followed by a lower trough. That's the definition of a downtrend. Gold has moved into downtrend on the weekly basis. And then if you take a look at that RSI has dipped below 50. Okay, let's go down to the daily chart. See that the daily chart here has moved into, I beg your pardon, is traveling in zone 3. That's the lower blue, lower red. Something interesting here. This is very interesting. RSI has pushed over sold. Okay, so that's interesting. I wonder how that factors in. If the yellow metal is oversold, is it going to suggest some sort of pullback up here? And if it suggests some sort of pullback up, then perhaps the key levels, that resistance level that we saw in the dollar, perhaps being a little bit more feisty than the yields indicate. But the idea here, where is the real story at the moment? What's driving the markets? Okay, it's the yields, and especially the real yield. That is driving the market. These are attractive yields. They're acting as a headwind against risk assets. They're acting as a headwind against gold. They're acting as a headwind against the majors. They're supporting the greenback. All right. Let me just see if there are any questions. Is this a risk-off scenario? I would suggest that it is certainly leaning towards risk-off there, Kim. From this analysis, Raj is saying it seems as if the US dollar resistance is going to fall. I think there is a chance of that, Raj. Again, nobody can say it definitively until after the fact. We don't have our key reversal, right? We don't have a reference candle reversal there, Raj. So without that reference candle reversal, we are, for all intents and purposes, we are attacking that resistance. We are attacking that resistance. It might fall. Yeah, let's see. I think that this week's going to be a really interesting week. Okay. Any other questions there, guys? All right. Let us wrap up here. Thank you very much for signing in this morning. Hope you found this useful. Have a great day ahead, a great evening, and we shall chat tomorrow morning. Thanks very much, guys.